You're watching Chairman's Briefing, and I'm Rachel Lee. This episode is brought to you by Graphite One. Let's get started. Gold refuses to rally despite troubling U.S. economic data that would be assumed to drive safe haven demand. The final first quarter GDP reading showed up worse than expected than the previous estimate of 0.2%. Consumer spending tells an even darker story. The revised figures show that spending rose just 0.5% in the first quarter, which is down sharply from the previous estimate of 1.2%. This marks a continuing trend of declining consumer activity that began at the start of 2025. Some economists dismiss the GDP report because import distortions from companies that are stockpiling goods ahead of Trump's trade policies have skewed the numbers. However, the consistent downward revisions to consumer spending cannot be ignored. Despite worsening GDP data and a softening job market, unemployment may not rise enough to force rate cuts this year. The chief economist of Co-America Bank, Bill Adams, explains that the counterintuitive dynamic of Trump's immigration policies will dramatically slow labor force growth. Foreign-born workers accounted for 4/5 of labor force growth from 2020 to 2025, but that pipeline is closing. When both job creation and labor force growth slow at the same time, unemployment rates can actually hold steady or fall. Adams points to post-Brexit Britain as precedent, where GDP growth dropped nearly a full percentage point, yet unemployment still declined. Adams believes that inflation could undershoot Fed expectations despite tariff pressures. If he is right, the Fed will cut rates because prices have cooled faster than anticipated, not because jobs have disappeared. Next, let's talk about Graphite One's feasibility study that tripled its resource estimates and delivered impressive economics. The company plans to mine graphite in Alaska and process it into battery materials in Ohio. Key numbers are telling the story here. Pre-tax net present value of $6.4 billion with a 30% internal return rate. Post-tax NPV reaches $5 billion with 27% returns, and the payback period stretches 7.5 years. The Department of Defense provided funding that helped to triple annual production capacity from 53,000 to 175,000 tons per year. Proven and probable reserves increased above 300%, while the measured and indicated resource also jumped above 300%. The kicker is that resource estimates here are based on drilling just 12% of the mineralized zone. The company targets first commercial production by 2028, with the Alaska mine starting in 2030. Awalé Resources delivered exceptional drilling results from its Charger target in Côte d'Ivoire. The junior hit 52 meters of 16.4 grams per ton gold, including 11 meters of 70.3 grams per ton gold. To put this into perspective, most commercial gold mines operate on grades between 1 to 5 grams per ton. Anything over 10 grams per ton is considered high grade. So Awalé's 70.3 grams per ton section qualifies as bonanza grade material. Additional holes returned 33 meters of 5.2 grams per ton and 10 meters of 12 grams per ton gold. These results came from drilling 70 meters below previous high-grade intercepts, confirming that the system extends deeper. Ascot Resources is teetering. The company cannot restart its Premier Gold project after shutting down less than 5 months into production. Premier was once the largest gold mine on the continent. Ascot poured its first gold in April 2024, only to watch operations grind to a halt due to insufficient underground development. Now the company admits that its mining contractor negotiations have failed completely. Unfortunately, the brutal reality is that Ascot lacks both money and skilled workers to restart the Premier mine. This failure stings particularly hard given the project's location in British Columbia's prolific Golden Triangle and superb ore grades. In today's record gold price environment, this mine should be generating serious cash flow instead of burning through investor capital. Imagine buying the same metal for two completely different prices depending on where you live. That's exactly what happened in copper markets this Thursday. American copper prices exploded more than 3%, while London prices barely budged, creating a stunning $1,500 per ton gap. This isn't normal market behavior. American importers are panic buying copper ahead of an expected 25% tariffs coming in September. The White House ordered a tariff investigation in February, and now traders are stockpiling before those levies hit. Goldman Sachs predicts that London copper will peak around $10,050 per ton in August. But once those tariffs actually take effect, Goldman expects prices to retreat below $10,000. Meanwhile, LME inventories have crashed 80% this year. American buyers are paying massive premiums for metal that they fear will cost much more very soon. Thousands of unemployed workers have marched through Panama last weekend, begging their president to reopen the closed Cobre Panama mine. This massive copper mine produced over 330,000 tons in 2023 before the country's Supreme Court declared its operating contract unconstitutional. It would have become a 100 million tons a year operation by 2024, placing it near the top of the world's copper throughput ranking. So eventually, the closure devastated local communities that depended on mining jobs for their livelihoods. While protesters originally demanded that the mine close over environmental concerns, now thousands of others are protesting for it to reopen because they need to work. The operator, First Quantum Minerals, and Panama's government have proposed a joint venture solution in April, but the mine remains closed since November 2023. And that's all of your briefing this week. If you're not subscribed to this channel yet, make sure to do so before you go and join the community. Thanks for watching. We'll see you next week.